Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good afternoon. Ira Epstein of Linn Associates with your agriculture update for this Thursday, the 20th of September, 2018, and we're about 4:20 p.m. Central Daylight Time. There's one thing I can tell you. Think of the word short covering. Maybe the market sold off too much in the grains. Second thing, the falling U.S. dollar. The third thing, the market's just feeling better that maybe the trade deals that are all out there, they're not going to get worse. End of discussion. And that gave you a bit of a rally today in the grains, and the market's held up. Wheat especially, it's put on a nice rally over the past few days here. As we come on and we look at the weekly area chart of soybeans, we're getting a short covering rally. The markets did not go through the old lows, and that was important on a closing basis, on a weekly closing basis. When you go to the daily charts, of course, the chart did go through these old lows, came down, and we're in what I'll call right now a good short covering rally. This market now has caught these people that what might have gone short looking for the market to come down, it's coming back on them. If we take a look, today's high took out that high, and the break low 2 days ago was under the swing line low. So what we have is a market with a lower low and a higher high. That is not a trend. The market is also, for the first time since mid-August, back over the 18-day average of closes. So the market's got the bias up. Anytime you're over the 18-day average, I say bias up. Market falls under it, bias down. And often what happens is you'll get markets that were trending down. They'll come up, they get to that 18-day average, slightly over it, and they'll play a game at it, just the way you did back here. I am not saying that I can predict the future. What I am saying is this is what I am expecting to happen, that this rally finds a way to pull back and get to that 18-day average again. And one of the reasons I'm saying that is because if you're a regular viewer of mine, you know that I really put a lot of stock in Bollinger Bands, which are an algorithm designed to give you a resistance and support level. The resistance level is 854.25, the upper Bollinger Band. You got today to 855, went right to it, pulled back, closed at 850.25. I'm looking for sideways action in this area. Is this enough to make the market pick up and run? Well, anything can happen, but I'm not seeing a reason for it to happen other than the market got oversold. When I look at the slow stochastic study, I was out yesterday, as everyone knows, with the holidays, but now the market has come back. Yesterday it had a bounce. Today it went through the 18-day average to that resistance. Very quickly, the market is no longer in oversold condition. So how I'm defining it is maybe it's trying to set up a trading range defined by the Bollinger Bands, no longer oversold, bias up, not overbought, and momentum up. Still no trend in the market. As we come over to the meal market, you still are left with a pattern of what? If we look at today's high, the last high of 518.90, you didn't take that out. But what did that high do? If we come back here, we see that this high was 318.90, and we see this one was 320.50. So you had a pattern of lower lows, and the market is trying from this point to get a bounce into it. I could really keep these arrows pointing down. The resistance is what I was thinking at 310.80. The way I teach charting, I should not have that arrow up. The red line should be down there. I erred on that when I was putting this together, and I'm the one that put that together. If the rally continues, you got to get through 318.90, and the resistance is waiting for you at 320.70. So yes, momentum is up, bias is up, but the trend is down in this market until you take out 318.90. In soybean oil, you're losing the embedded reading. Now, take a look at these numbers. If we go back, you'll see both numbers were under 20, both under 20, both under 20. They weren't here, but you had 3 days in a row as of yesterday, and you lost it today. When you lose it, it is not uncommon for the market to make a run to the 18-day average of closes and sort of run out of its zip at that number as it rebuilds and works itself out of this. The only time you can re-embed, and embedding is very important, is if the market opens good and lower tonight and keeps dropping and turns that red line down. Other than that, this market could be a trap for those that went short on this break right now. Maybe it's running out of that downside momentum. I don't see anything bullish on it, but I'm not as bearish as I was. In the corn market, you lost the bearishness. The pattern is now one of a lower low and a higher high. I'd be looking for the 18-day average on that rally to do what? Get up and run into resistance. That number's 357 3/4. You got to 356 1/4 today, so I'm going to call it no trend now. Momentum never embedded. It's just plain oversold. Wouldn't be surprised to see a battleground near that 18-day average of closes. When you lost the embedded reading back here, the market started a pattern where I was looking for the market to get up to the 18-day average of closes. It pulled back. The last time I saw you was Tuesday, other than today, and I thought maybe you can get to that 18-day average, and now you've done that. So I'm looking at a market that has hit its upside targets, and now the question is what next? At this point, the trend is up. You've got higher lows, higher highs, momentum is up, the bias up because you're over the 18-day average. Should this market reach further up, the 100-day average could be the next resistance at 540, and as I said, you're not in oversold territory. So until you take out this 506 and let's call it 506 level, I'm going to say that this market has turned its trend to the upside. In the sugar market, you lost all this momentum to the upside. You pulled back down, and you're fighting the battle that I'm talking about in the grains, where I think you're going to fight at the 18-day average of closes. This is the exact way that that looks. Now, you might say, what if the market starts down from here? All you need to do is take out today's low to have a pattern of lower highs and then lower lows. The problem is, if you look at stochastics, you have a reading under 30. That means you have an oversold condition. Battleground, I'll still argue, 18-day average of closes. In the cotton, we've been witnessing that each time this market has rallied to this 18-day average of closes, really since July, it has had a failure. That's the pattern that I keep looking at. Until that pattern changes, with the market getting back over 102.45, getting a pattern of at least a lower low and a higher high, all I can say is that the market is what? Exhausted itself on the decline against the Bollinger Bands. Once you get back to the 18-day average, even if you take out 102.45, you'd end up with a pattern of a lower low and then a higher high. I can't see an uptrend at that point. I can argue that the pros might be still looking at 101.10 as a sell zone. In the cocoa, the trend is down but oversold. Lower highs, lower lows. This is called riding the lower Bollinger Band. And that often happens when a market has developed some sideways action in the Bollinger Bands, and then the market tries to establish a trend. Now, when that occurs, you often first get oversold, which you're doing in this market. Do you embed or correct the oversold condition? That's what the market is really going to look at. Now, let's talk about what I do to get you going. As you can see here, that's a morning subscriber video. This is what my written updates look like. I write 2 updates a day minimum. One in the morning, try to get it out at 11:30, and one at night before 8 p.m. ideally for you. In those updates, I cover lots of commentary. When I write at night, I'm giving you the commentary for the next day, what the market's looking for, reports coming out, what the estimates are on the report, the importance of what's going on, if there's a big meeting taking place that can impact the markets. So you get all that, you get the trade ideas, and I start you off at 8:30 in the morning with a video where I record 40 different charts live, and I'm showing you what's going on and what I'm seeing out of that. If you haven't tried it, you might want to give it a free shot. No credit card, nothing from you. Call us. You can go to our website to sign up for that, and you can also click right up here. That'll take you right to our webpage to sign up. I'm Ira Epstein. You have a good day, and I'll talk to you all tomorrow.